Hello, everyone. Welcome to this week's OWA Live. Today, we thought it would be good if we dove into the coronavirus and how that's affected our economy. So we'll be using a couple of slides that we used from our halftime report that is recorded in here on our YouTube page. We'll put a link down below in the description if you're interested in watching that 40-minute presentation. Let's dive in here. So I'm going to share my screen and we're going to go through some of what we noticed with the coronavirus. So the first thing that we see obviously is the markets. We want to talk about the S&P 500, talk about how that volatility played out in the markets. So we can see here in beginning part of March, late part of February, we started to see that coronavirus dive. That kind of volatility was mostly due to the disruption in the supply chains. We saw not only cities and states, but entire countries shut down as that coronavirus was in full force. So here we started to see that volatility. We saw things start to drop, and it was fast. Man, the volatility that we saw in the S&P 500 was drastic. And it wasn't only in the S&P 5. We also saw the Dow Jones lose a significant value and the NASDAQ. As a matter of fact, most markets were down. Russell 2000 was down very dramatically. Small caps got hit very, very hard through this. Top to bottom with the S&P 500, we were down about 34%. So we know about that market volatility. We know how COVID affected that situation. Also, kind of interesting, we've seen a drop in inflation. We are trying to analyze and find out why this is. A lot of this is due to energy CPI. We know what happened to oil through this coronavirus situation that we were all facing. Very interesting to see that the consumer price index has dropped so dramatically. So we're almost in a period of deflation, which is going to be very interesting to see how that plays out. We have been in periods of deflation before. In 2008, the consumer price index was negative. Means the price of things tomorrow is probably going to be cheaper than the price of things were today. So a good thing for spenders, you would think, but it's actually really, really bad for the United States economy to have periods of deflation like that. So the Federal Reserve Board is working very, very hard to make sure that we don't dip into negative CPI. They're doing just about everything they can to make sure that that's not the case. And we're keeping an eye on inflation moving forward. We don't think it's too far-fetched. It's too far out of the realm of possibility to start seeing some significant increases in inflation too. I don't know if it's going to be bad as it was in the 80s, but we should expect some level of inflation moving forward. We all know about unemployment. The unemployment rate right now is sitting at about 12% or so. You can see in April it was sitting around 14%. So there's a lot of uncertainty there. Wage growth has shot up as well. The main reason for that is because those lower wage jobs are not included anymore. Most of those individuals were laid off or furloughed. So the United States isn't reporting on those lower incomes. A lot of people are seeing this and calling it an anomaly. It's not really, honestly. It's kind of expected given those lower wage earners being removed from the job pools. The unemployment is a big deal right now, though, and we are at historic high levels. We'll have to do something to get a fair share of the population back to work. Here's kind of an interesting one. Home sales have started to fall. We didn't think that was going to happen. We thought that the housing market was strong enough to support that, but here, looking from February to May, we're seeing a significant dip. And the boost that we usually see through the summertime isn't really happening right now. We're seeing summer home sales slow down dramatically. That's not to say that they're not happening. We're still seeing somewhere in the neighborhood of about 3.8 million homes being sold on a rolling 3-month basis. But you can see that the trend is suggesting that those existing home sales are falling. Also, GDP. We already know we're in a recession. We know that the economy has slowed. We're forecasting right now in 2020 that we're going to be somewhere between a -4 and a -10. That's not a good thing. That means productivity has slowed down pretty dramatically. That's a slowdown in our overall economy. You can see we've usually tried to maintain somewhere in the neighborhood of a 2 to 3% GDP rate. We're significantly below that right now. I think GDP for Q1 was -6. So we're gonna have to really start working and getting quarters 3 and 4 up and running. The good news is the Federal Reserve Board is projecting that we'll see a boost. 2021 will be a very productive year to catch up for the negative GDP that we saw in 2020, in this year. And a lot of that's directly related to COVID. We saw not only people losing their jobs and the United States economy decreasing, but we aren't spending as much. You and I aren't going to the store, and we're not going on vacations or anything like that. So as spending goes down, that GDP will drop as well. It's not all bad news, though. We had prepared for this, whether we realized it or not. Debt as a percentage of income has reduced dramatically. So in Q4 of 2007, right before the mortgage crisis, we were sitting at 13.2% debt to income ratios. That's pretty dramatic. That's a lot of money. And this is a revolving debt. So usually things like credit cards and lines of credit. Look at how much that has reduced. We are at historic low levels, sitting at 9.7% as of Q1 of 2020. So we've learned. We as Americans aren't holding as much volatile turnstile debt. We have paid that debt down so that we don't have those large credit card payments. Other good news, the markets are almost back to where they were. So the slide that we were looking at before was from a couple months ago. We've seen a couple of good months of run up. Through the summer, through July and into August, we've seen the S&P 500 knocking at the door towards all-time highs again. We're not quite back to the level that we were before. We're still down a little bit on the S&P 5, but overall, it's looking pretty positive. Even though the coronavirus volatility came quick, we've seen a somewhat quick recovery as well. Now, whether that continues is anybody's guess. We don't really know what's going to happen in the future, but the main thing that we're telling people right now is to stay focused on the fundamentals, meaning make sure that your portfolio is well balanced, is well managed, and make sure that it matches your risk tolerance. If you're invested in something that you aren't comfortable in, you shouldn't be there. And you shouldn't have been there for as long as you've had that lack of tolerance for market risk. If you are comfortable with market risk, more power to you, full steam ahead. We would suggest sit down with your financial professionals now, whether it's us or whoever else, and make sure that your risk tolerance matches what your portfolio says. And remember, stay focused on the fundamentals. Don't let emotion, don't let what other people are saying about the markets, don't let sentiment, don't let any of that stuff control how you invest. Make sure that you're investing according to your own strategies. We hope this helps. Reach out to us if you have any questions or concerns. And until next time, we will see you at OWA Live. Have a great week and stay healthy.